Hello and Assalamu alaikum. I am Kashif Kamran, and this is my exam tips session for Advanced Audit and Assurance for March 2022 exams. Currently, I am looking at the exam tip number 5, which is significant audit risk. The previous 4 exam tips, 1, 2, 3, 4, has already been posted on my Facebook page, which is AAA by Kashif Kamran. This is the 5th tip, and I'm making a video for it because this is a very important tip and you need a good understanding for this in terms of your exam paper. Now, what basically is a significant audit risk and what your examiner expects from you when the examiner use a terminology, evaluate a significant audit risk or evaluate a significant risk of material misstatement. Now, just to focus on this, from September 2021 exams, there was a revised ISA 315. And this revised ISA 315 was covered in the Examiner article, which was published prior to the September 2021 exams with the title of Risk and Understanding the Entity. And this article, Risk and Understanding the Entity, which was in line with the revised ISA 315, introduced for the first time the terminology significant risk. Now, in line with the revision of ISA 315, the examining team has started to use a terminology significant audit risk in the AAA paper. It's not coming in every single exam sitting, but if it comes in an exam sitting, instead of examiner asking you evaluate the audit risk, what if the examiner asks you evaluate the significant audit risk? Already in the recent published paper, which is the September-December 21 paper, the examiner has used the terminology evaluate the significant audit risk. So if you come across the terminology evaluate the significant audit risk, how would that shape your audit risk answer? Or how would that shape your risk of material misstatement answer versus simply the examiner asking you evaluate the audit risk or evaluate the risk of material misstatement? So how would you go about changing your answer if the question asks you evaluate the audit risk versus evaluate the significant audit risk? So how would you bring the change, or how would you change your answer to meet the expectation of the examiner? Now, I've already covered this article, Risk and Understanding the Entity, which was introduced prior to September 21 exams, even in my September 21 webinars, which is on my YouTube channel. And also, I have covered a very specific video on this particular article, Risk and Understanding the Entity, which is on my YouTube channel. And the hyperlink of that is given right over here for your ease of access. Now, the question number 1, which is a 50 marks question, and we know the most heavyweight component in the question number 1 is risk. Now, examiner in a certain exam setting do ask for evaluating the significant audit risk or risk of material misstatement. So what should specifically be done for it? Now, what if in the March 22 exams, the examiner asks you evaluate the significant risk of material misstatement? How would you react to the word significant? How would you ensure that the answer you have written covers the significant risk of material misstatement? How would you go about it? How would you ensure you have done justice to the terminology significant? So this particular video, which is on the exam tip 5, significant audit risk, will assure that you get the right concept and you do the best in your March 22 exams. Let's move on. Now, when I was looking at the September-December 21 examiner report, which is a very wonderful resource, and I always encourage my students to read examiner reports, at least 3 to 4 recent examiner reports, which really brings a significant impact to your exam quality and the way you attempt your exam paper. Now, when I was reading the September-December 21 examiner report for the question number 1, audit risk, because this question number 1 on audit risk used the terminology significant audit risk. And there was some very interesting comments of the examiner from which you can exactly learn what to do when the examiner asks you significant audit risk. So right from the examiner perspective, we are trying to understand what is the best definition of a significant audit risk. Because one definition of a significant audit risk could be in the BPP book, one could be in the Kaplan book, one could be from the tutor from where you have taken your AAA classes. But this definition is coming from the very authentic source, which is the examiner of your AAA paper. And in the September-December 21 examiner report, the examiner is exactly telling what your examiner expects from you when the examiner asks you significant audit risk or significant risk of material misstatement, just like in the September-December 21 paper. Now, on the left-hand side of my presentation, you can see that. I'm just going through it. The requirement asks only for significant risk in September-December 21 paper, which means risk that are either specific to scenario, that's number one, right? You are picking up the risk which are given in the scenario, number one, risk which are specific to the scenario, comma, non-routine. So either you are picking something from the case which is non-routine. I'll just give you an example of that. That's number two. And number three, or something which is judgmental. Number three, which is judgmental. Number three. And number fourth, if you are evaluating a significant audit risk, any situation in the exam paper which give rise to a detection risk. So a detection risk will be a significant audit risk, right? Because when you look at the formula of audit risk, the audit risk formula consists of detection risk. So any situation in the case study which give rise to a detection risk will definitely be a significant audit risk, right? So detection risk will also be considered in the definition of a significant audit risk. Four things. Number one, something specific to the scenario. Number two, non-routine. Number three, judgmental, and a detection risk. Now, if you are attempting a question on a risk of material misstatement only, we know risk of material misstatement does not consist detection risk. That means you're left with three: something specific to the case, non-routine, and judgmental. But if you're doing a question on audit risk, the fourth element also gets added, which is detection risk. Now, this is the breakdown of the terminology significant audit risk from an examiner perspective. Let's understand each one of them very carefully through examples over the next 10 to 15 minutes of this session. And let's see if you get a clarity on how would you be going about towards your March 2022 exams. Before I get to that, the next paragraph, speculative risk arising from routine transactions generally will not obtain credit. So if you try to pick speculative risk from routine transactions in the case study, ignoring the non-routine transactions, I'll just give you a bifurcation between routine and non-routine, but examiner is saying, I would not like to see in your answer speculative risk. So that's the big cross. Examiner don't want to see the speculative risk. Examiner don't want to see risk coming in your answer from routine transactions. So examiner is not liking to see risk coming from routine transactions into your case study. Candidates demonstrating strong professional skill will be able to differentiate between a speculative risk and a specific risk, and not spend time discussing topics which will not obtain credit. So if you are a clever student, if you have studied the proper AAA with proper practice of the past paper, by this point in time, you should differentiate between what is speculative, something which is routine in the case study, something which is not specifically highlighted by the examiner in the case study, and you start to take some hypothetical assumptions around it, and ignoring the specific paragraphs given in the case study, or ignoring the specific information given in the case study, or ignoring the specific facts given in the case study. That is absolutely wrong. So routine transactions, speculative risk, examiner is not liking that, right, when it comes to significant audit risk definition. But the first paragraph is the crucial one. Something non-routine, something judgmental, something specific to the case study, and something giving rise to a detection risk. Now let's build up our discussion on the four parameters in the first paragraph. Moving on. Candidates are told in the question number 1 of the December 21 exams that the client owns a head office. So the client owns a head office property and leases a production facility. So when you were reading the question number 1 of the September-December 21 exams, which is uploaded, The scenario was telling you that the client owns a head office, number one, and they also leases a production facility too. The client has purchased a new investment property in a retail development, and the client has purchased a new investment property, full stop. If we consider the risk in the three different areas, what will they be? Whether they will be routine, non-routine, whether they will be significant or hypothetical. Now, you already own a head office, right? For last many years, and you know how to account for a head office because it's becoming a routine transaction for the management for the last. It is not saying for the first time you had owned a head office property. No, it's a routine. You leases a production facility. It's not telling you leases this year. You leases the production facility means you already had a lease of the production facility for last couple of years. So it's more like a routine transaction. Something which becomes routine, the chances of an accounting error or the chances of an accounting misstatement goes down versus something which is happening for the first time. If something is happening for the first time, like an investment property, there are chances of misstatement. How will the management account for the investment property? Has the management taken the right accounting treatment for the investment property? There are significant chances that they might do the wrong accounting treatment for investment property. So when you look at the three things, a head office, a lease property, and a new investment property, among the three, the most significant here is the new investment property. Why? Because it's new. An examiner was saying you have to focus on something which is non-routine. So something which is new automatically becomes non-routine. So this is something non-routine. And when you look at a head office, when you look at a lease production facility, that's something regular happening since last couple of years with this client. So that's becoming more routine for the client, right? So that is one definition. Now let's see how the examiner is telling you the constructive criticism on the head office, on the lease production facility, and on the new investment property. And that will really open your mindset about, oh, that is a significant risk. And we were doing mistake when we sat for the December 21 exam. And that's the reason we failed the December 21 exams. Let's go down and find the answer. First, with the head office building, the first one. So the client owns a head office building. Now look at the left-hand side of the presentation and see what the examiner is criticizing, because examiner is saying, I don't want a routine transaction as a significant risk. Now on the left-hand side, the examiner writes, head office building owned outright. This is a routine property, plant and equipment. Under a historical cost method, the only risk to this as an ongoing transaction, as a routine transaction, is the estimated useful life. So the only risk is the estimated useful life with the property, plant and equipment, because it's a routine transaction. Candidates are not given a value of this property. You were not given how much is the value of this property, nor told that the client is depreciating over an unreasonable time. Not even the examiner telling you that the management has taken a wrong useful life assessment. Even if that was told, that would have been a very specific audit risk. But the question is silent. The question is only telling you that you own a head office. Are you depreciating the head office over an inappropriate useful life? No, examiner is silent. So even though there is a risk of an estimated useful life, but the examiner is not telling you there is something inappropriate with it. And first of all, this is a routine transaction happening for the last many years. As depreciation of a property, plant and equipment is generally a low risk area and there is nothing new or unusual about the property, it does not give rise to a significant risk. It does not give rise to a significant audit risk. Why? First of all, it's routine. You own a head office for last many years. You are depreciating it for the last many years. You are familiar with the accounting treatments. Yes, as a thought process, the only risk in a property, plant and equipment is the depreciation, is a useful life, but the management, the examiner is not telling us something inappropriate about it. The examiner is silent. If the examiner is silent, that's fine. Now, this is where this particular risk will not be considered as a significant risk. So I hope you get the examiner perspective. And the more important hint is if it would had been a significant risk. If, look at this, examiner is telling us candidates are not given a value of this property. If it would had been a significant risk and the examiner would like your attention being drawn to this, examiner must have given you the value of the head office so you can find the materiality. If a value is not given to a certain risk, it is also a hint. It is also a hint for all of you to consider, is it significant? Because examiner is not giving you a value to find the materiality. Yes, some of the transactions can be material by nature, but this is not a transaction material by nature. This is a transaction material by amount. An examiner is not giving me a value. So if you are a clever student in the exam, you say, okay, a value is not given. So it is not a specific risk. It is not a significant risk. If it was, examiner must had given us a value. So value is one hint. Head office is owned for last many years, so it's a routine transaction. So examiner is not happy if you consider this as a significant audit risk. Moving on, the next one, leased production facility. Now, a leased production facility, on the left-hand side, the examiner comments on it, whether it was a significant risk and why or not. Leased production facility, leases are not judgmental because you have a lease agreement, right? You know how to classify the lease. So lease are not judgmental area of the financial statements. In the absence of further information, it would be speculative to think that this lease might be under a year and covered by the exemption of the journal lease rules requiring the recognition of a right of use of asset. No, examiner is not telling you anything about it. So if you start thinking, oh, is this lease under a year or covered by exemptions to journal lease rules, you're thinking hypothetical. Examiner is simply telling you there is a production facility which is leased, and obviously lease has an agreement. So anything which has an agreement is not a judgmental area. So by being not a judgmental area, this is not meeting the definition of a significant risk. The head office was more routine. The leased area is more non-judgmental. In the second bullet, the examiner is telling us, this is not a new lease. It's going on for last couple of years, right? This is not a new lease. So if it is not new, this is something routine where the client may not understand the lease accounting. If it would had been a new lease, then there would have been something significant here that the client might not understand how to account for lease. But this is not new, nor is judgment involved in accounting for lease. No financial information has been included to enable calculation of material, just like the head office, right? No financial information so that you can calculate materiality is a hint, right? That this cannot be a significant risk. So no materiality calculation involved. This is something routine. It is a non-judgmental area because the lease of a production facility is going on for the last couple of years. So there is no basis to assume this is a significant risk. If following lease accounting rules had been significant, what if the lease was a significant area? This would have been identified during acceptance and information given about inappropriate accounting treatment utilized. If it would have been a significant risk, examiner must have given you the value first. Second, examiner must have talked about something inappropriate in the lease. But when the examiner is not talking about something inappropriate in the lease, examiner is not giving you the value of lease, that means you have clear indicators that this is not a significant risk. So first, it's routine. Second, it's non-judgmental. No materiality given. Examiner is not telling you anything wrong about lease in the given information. So I think these are good indicators to conclude this is not a significant risk. Now you move to the last one, new investment property. Now you can see this word new automatically means something non-routine, something happening for the first time. Now, so many times in the past papers, we see the word new, a new accounting system, a new event, a new transaction, something happening for the first time. You are acquiring a company for the first time. You've never acquired a company before. Or you have introduced for the first time a share-based payment scheme for your directors. You've never introduced a share-based payment scheme for your directors. So you might do a wrong accounting treatment because it is for the first time. A new accounting system has been introduced. So if it is a new accounting system, initially there could be some blunders and errors in the new accounting system. So anything which is new, like an event, like a transaction, like a system, alerts you that this is non-routine. And anything which is non-routine automatically meets the definition of a significant risk, whether materiality is given or materiality is not given. Something which is non-routine automatically becomes a significant risk, irrespective of materiality. But can a routine transaction become a significant risk? For that, materiality has to be present. If the materiality is not present, then you cannot say that a routine transaction is a significant risk. Moving on, new investment property on the left-hand side of the screen. New investment property. This is an area of risk as it is a new transaction for the client, non-routine, and there are requirements for the classification which must be met. The client also has the choice between two different accounting policies, and the method the client has chosen involves judgment. Now, how to account for investment property? There are two options available to the client that also give rise to the judgment that which option are they choosing. So two different acceptable accounting policies and the method the client has chosen involve judgment. So first of all, it's new, number one. Second of all, it involves judgment, automatically making it significant, and the estimates of the fair value. So the management has chosen an accounting policy where a fair value needs to be estimated. So estimating of the fair value, right, is a judgmental area. New is a non-routine. In addition, the values are given. Interesting. The examiner has given us the value of the investment property. Values are given for materiality calculation. And another third point here. Is it new? One. Is it, does it involve estimates? Two. Does it, can we calculate the materiality? Three. So all factors going in favor of this is a significant risk. So these judgments and choices may reflect the management bias, how the management choose the accounting policy, which accounting policy are they choosing? Are they determining the right fair values? Can they use fair values for a management bias? So this is a significant risk. So head office, routine, no values given. Thinking about useful life will be too hypothetical. Leased production facility was not new. No materiality calculation involved. And there was nothing wrong against lease, which the examiner was telling us. So it was ruled out. New investment property met the criteria of a significant risk, firstly, because it was new, materiality was given, and it involved judgments. So we had three good factors to decide, oh, this is a significant risk. So that's how you think about significant risk in exam paper. Now you are reading the case, you have a reading and planning time, right? In a reading and planning time, you're reading the case and you pick up the risk. Head office, okay, underline. Leased property, underline. New investment property, underline. But the moment you see the word new with the underline, you will think, oh, this is a significant risk. So you might come across 20 risk in a 24 marks answer, but you're not writing the 20 risk for a 24 marks answer, right? Because the marking scheme is different. And I'll be guiding you about the marking schemes. Already guided you about marking schemes in my previous webinars and will be guiding you again as well. But if you find 20 risks when you were reading, now you need to choose which 8 or which 9 or which 10 perhaps maximum. Otherwise, I think for a 24 marks answer, roughly 8 to 9 risk are fine. 8 to 9 risks, which will be prioritized, which will be significant. Now, you know, the significant is either new, either something non-routine, either something judgmental, or a specific detection risk, something where a materiality calculation is involved. So already a lot of hints have come to you. Okay, moving towards some wrapping up phase now. Risk of management bias. Now, a lot of time, when you're reading a case on audit risk or risk of material misstatement, students are very happy picking up risk of management bias. But the examiner is not happy with it. Examiner thinks that a risk of management bias can be a non-significant risk if it is not connected with the case study. But if a risk of management bias is connected with the case study, it becomes significant. Let's see how. Candidates must remember that when discussing risk, it is important to relate them to a scenario, specific. rather than discuss abstracts or generic. This is a listed company, for example, and the students say, oh, it's a listed company. There is a risk of management bias because they can manipulate the profits to deceive the shareholder. Full stop. Have you seen in the case study whether the profits are inflated? Have you find the trend of the profits? So if it is a listed company and you just write a generic statement, because it's a listed company, there is a risk of a management bias that the management can manipulate the profits to achieve, to get bonuses, full stop. But at least if you want to make it specific, you will identify how much is the increase in the profit from the last year. This is a listed company, full stop. The profit over the last year has increased by 20%, whereas the sales over the last year has increased by 15%, which indicates that there might be a risk of management bias in overstating the profits and revenue to achieve bonuses. Now, at least you brought the link to the percentage of the revenue and the percentage of the profit. So the first statement where you were just writing generic inflating profits, in the second statement, you connected the inflating profits and revenue with a case study. The second statement is far better than the first one. This is particularly an issue when discussing the risk of management bias. This is a key concept to understand for the auditors, as it can impact upon judgments made by management in driving their figures for the financial statement. Obviously, when there is a risk of management bias, the management bias can be used to manipulate the financial statement, no doubt about that. But if you just write a generic management bias statement, not connecting the bias with the financial statements, not connecting the bias with the given information, not connecting the bias with the profits and the revenues, you're writing a very generic risk of management bias, which is not worthy of credit. Candidates must able to understand the concept of bias to be applied to a AAA paper. Let's see how the examiner is giving us examples of bias from the given examiner report. Risk of management bias. Number one, the examining team are often faced with two standard candidates' responses to management bias in a section A question. Either one of the candidates says, inverted comma open, the client is listed, so management will be biased to keep the shareholder happy. Now, the examining team is saying this is the most common statement we come across, or open inverted comma, the client is not listed, so the owners will be biased to keep the profits low and save tax. Interesting. The client is listed, so there is a biasness. They will keep the profit up, shareholders happy. But if the company is not listed and you want to save tax in a non-listed company, so if the company is not listed, you will keep the tax low, you will keep the profit low to save the tax. Now, examiner says these are two situations we mostly come across when we are checking the papers. Now, see how the examiner criticizes you in the second one. The first statement, listed company, doesn't include scenario-specific reasons for this conclusion, and therefore it's too vague and generic. I just told you that if you say the management will be biased, try to connect the biased with some numbers like revenue, like profit, try to find out the percentage, try to find out the ratios like a gross profit margin rising over the last year or a net profit margin rising over the last year. So if the net profit margin is rising or the gross profit margin is rising and you try to calculate that and put that in your narrative answer, that's worthy. But if you're just writing a journal statement, shareholder happy, no. The second implies that all non-listed company clients are concerned with aiming for lower payments in respect of tax. It is just a journal statement that a non-listed company wants to save tax, so they will keep the profit lower. So the profit could be understated. But examiner is not happy with these generic statements. Let's see what is the solution the examiner is giving to us. Number three, again, this is a generic statement, keeping the profits low. And unless there is an information in the scenario which indicates that the profit has been kept low, or there is an indication that it was a non-listed company and the profits have reduced down over the last year, then you can at least relate it with a case study and specifically alludes to this. Then candidates will not receive credit for making this point. In both cases, neither will be credited as an evaluation of a management bias for specific. You just wrote a statement which you learned before you enter the exam hall, and you just wrote a journal statement. It's not worthy of credit till the time saving tax or lower profits are linked to the case, or keeping shareholder happy are linked to the case. Now let's see what was exactly in the September-December 21 question number 1 and how the examiner is reacting to it. In the September-December 21 question, the business is owner managed. Now see how the examiner reacted to it. Candidates are told that the business is owner managed and the main shareholder is in the process of selling his shares in the company. So owner managed business and the main shareholder of this owner managed business is in the process of selling shares in the company. Now see, selling is increasing the risk of buys. Now selling is a case specific information. So if a main shareholder wants to sell shares, the selling is increasing the opportunity for business, and that's connected to the case study. Now see how the examiner is telling us the right answer. The specific management bias point is this, in this scenario, is the desire to make the company look attractive as possible for a potential buyer. That is specific identification of the management bias. You want to sell share and you want to attract a buyer. And to attract a buyer, you want to keep your financial position healthy. You want to keep your financial position attractive so that a buyer is attracted to buy shares. So the selling of the share is creating an opportunity for the financial statements to be fabricated, the financial statements to be made attractive. You can also investigate the numbers given to you in the question number 1 to see whether the financial statements indeed have been made attractive, like the gross profit margin, like the net profit margin, or something rising over the last year. But this is a potential risk of a management bias because it's given in the case study. So main shareholder wants to sell share. So selling share is a linkable management bias, is a case specific management bias. I think in one of the past paper, there was a scenario in a listed company that the management do get an annual incentive scheme like bonuses. And that was given in the case study, that the management gets an annual incentive scheme on the basis of performance. Now, yes, because they're getting an annual incentive scheme on the basis of performance, now the performance can be manipulated. And you need to judge in the case whether it has been manipulated over the last year or not, because they want incentives, and for incentives they will manipulate the performance. Now that is a case specific management bias. So that's how you think about realistic situations. Summary: significant risk. Now when you look at a significant risk and you look at the last 10-15 minutes of this video presentation, number 1, a specific risk is the one which is a significant risk is the one which is specific to the case. Just like the management bias we were discussing about, the management bias relating to a main shareholder selling share was a specific management bias. But if you just see a listed company and you write a journal statement, you see a non-listed company and you write a journal statement, that will not be specific to the case study. So try to find the risk from the situations presented by the examiner in the case study. Number 2, a significant risk will be the one which is non-routine. Just like we had a breakdown of a head office, a leased property, or a new investment property. Something which is judgmental, which involve fair values, estimates, fair values, provisions. There are so many areas in the case study where provisions will be discussed: impairment, recoverable amount, determining the recoverable amount, determining the fair values, determining the estimates, determining the provisions. These are all judgmental areas. Choosing between the right accounting treatment, investment property, choosing between which accounting treatment should be applied. So you will come across lots of situations in a question number 1 where judgments will be exercised by the management. So judgmental areas automatically become significant, whether the value is given or the value is not given. Something which is non-routine becomes significant, whether the value is given or the value is not given. Involved materiality. Where a materiality is involved, that is also an indicator that why has the examiner given you the value? Examiner has given you the value to calculate materiality. And why the examiner wants you to calculate materiality? Only because it's a significant risk. So examiner will never give you a value with an insignificant risk. Examiner will only give you value with a significant risk. So is materiality a hint that this is a significant risk? Yes. So where a materiality is involved and you can find how much is it of the profit, or how much is it of the total asset, or how much is it of the revenue, then that is a clear hint that this is a significant risk. So where a materiality is involved, it might be a routine transaction, but a materiality is involved, automatically becomes significant. Or it might be a non-judgmental area, but materiality is involved, it automatically becomes significant. So either it's non-routine, either it's judgmental with value or without values, or it's materiality calculations. So wherever you see a materiality calculation in the case study, you will become alert, oh, this is a significant risk, whether it is routine or whether it is non-routine, whether it is judgmental or it is non-judgmental. But materiality will be a driving factor in picking up a significant risk. And the last one, detection risk. Wherever you come across a situation where you think the auditor will fail, it's a new audit client. How many times you've seen in the past paper, it's a new audit client and you're doing a question on audit risk. So in a new audit client, you have a very specific detection risk because the auditor has less knowledge of business in the first year audits. So specific detection risk is also a significant audit risk. So if you go through the examiner report of September, December 21 exams, and you just read through the question number 1 examiner report right here. See this on your screen. Question requirement B, 24 marks. Examiner report, using the information in Exhibit 1, Exhibit 2, Exhibit 3, Exhibit 4, evaluate the significant risk to be considered, 24 marks. And then the examiner is giving you the criticism. See how long the criticism is. I've just taken a summary. Examiner is giving you a criticism that what was wrong with this 24 marks answer. It's going on page 1, it's on the page number 2, it's on the page number 3, it's on the page number 4, it's on the page number 5, and it ends here. 5 pages, just telling you about what was significant, what was insignificant. But try to read it, because in the last few days before your exam, normally what you do wrong is you don't spend time on reading examiner reports, and you can learn so much from them. So I hope you got some clarity from this exam tip number 5 about what is a significant risk, because this terminology has started to come on an irregular basis in the last couple of attempts in September 21. So what if this terminology comes in your exam paper? I hope you have a better mindset of picking up non-judgmental areas, non-routine areas, specific information from the case study, trying to pick up the areas which involve materiality and detection risk as a prioritized risk, as a significant risk. Examiner can even use the terminology, evaluate the prioritized audit risk, evaluate the significant audit risk. So prioritizing of risk. How would you prioritize risk? On the same basis as you've done the significant risk. So you need to pick the risk on the basis of the summary in front of your screen, and you are picking up the right risk then. So this is the tip number 5. I hope you learned something out of this tip 5, which was significant audit risk. And the previous 4 tips have already been posted on my Facebook page as like narratives. This was the first one where I've put up a video, because this was a more insightful one, and more tips to come. Tip number 6 onwards, where a video is needed, I'll put it up. Otherwise, it will be narrative on my Facebook page. Thank you so much. I wish you best of luck for your March 2022 exams. This is Kashif Kamran signing off from exam tip session, significant audit risk. Goodbye and Allah Hafiz.